Hi everyone. So I'm Sandeep Anand. I've been an investor since last 10, 12 years and have been practicing investing over the course with a lot of failures and success which has kept me afloat. My strategy is very much an amalgamation of all the learnings I have had from a lot of great investors and across the globe. So I wouldn't like to call out any specific names here. I mean, obviously the Warren Buffetts of the world, but it is a derivation of a lot of books and the learnings that I've had. And I decided to create a framework for myself, which is very important. Every investor, I believe, should have their own framework and their own processes which they believe in, so that it can be repeated and replicated over long periods of time. So with that, I created my own framework called Neo Value Investing Framework, and I decided to practice that and teach that, which is what I teach in my Investors Academy to all the new investors. Now, having said that, the idea of my framework is predicated on the value investing thesis, starting from the Benjamin Graham days, and it also has been influenced by Warren Buffett, Charlie Munger, Phil Fisher, Peter Lynch, a lot of people, Howard Marks, and all of them. Now, what I really started practicing over the last 5 years has been, based on the book called 100 to 1 in stock markets by Phelps, which has had a significant impact in my investing process and my outlook towards investing. So the awakening call for me in investing, I would say, is to look at a bigger picture and to dream big. That was the first call that changed the way I look at investing. So aim for those elephants. So that is, like, very few investors seek the big game. And they focus on chances to make 5 points here and 5 points, 10 points there. They rush to buy on information that the next quarter's earnings will show a good increase, or to sell because they hear that the profit gains have slackened. So looking at companies from quarter to quarter is something I've stopped doing a while back, and rather play the bigger game. Look for the forest, and don't look for the trees, and rather look at the bigger picture, dream big, make wealth, not income. That's what I've decided to create in the stock markets. So when I look at investing in a company, I don't get perturbed by the quarterly earnings, or a down move because of the quarterly report. I look beyond that. So that is the first awakening call, and only if you do that, you can look at investing in companies, that rather than looking at investing in stocks. That is the biggest lesson I've learned, and that's the starting point with which I invest in companies. Now, the second game of investing is my course, my flagship course in the Investors Academy, where I teach investing like a gaming concept, and making it in more interactive, intuitive for academy members. So game of investing is a course, and I'm coming with a book on the same name, and my blog is also called Game of Investing. I call it a game because it's a game of temperament, and it is pretty much a game, like, where the only difference is, like, many people can win this game of investing, unlike other games where there can be only one or two, or a team that can win. But whoever finishes this game of investing is a winner, and all you need to finish is to preserve the capital. As the rule goes with Warren Buffett, the first rule, do not lose capital, and second rule, do not forget the rule number one. So the big risk is in correcting errors in the stock market, is that stocks look best to so many of us when their prices are highest, and worst when their prices are lowest. The market is such an animal, that where the nature of the beast is in such a way that we feel good when the stocks we hold keeps going up, and we feel extremely bad when the stocks goes down, whereas it should be the other way. When real investors who really look for value should appreciate the downfall and take opportunity of it, and should be careful and cautious when the stock prices are mayhem. It's in a uplift mode, where every tide is going up. When there is a bullishness all around, is need to be the exact time when we need to be cautious. So that is some thing about temperament. So it's investing is a lot about wiring, natural wiring, and temperament. But the good news is, you could improve your temperament. You could practice improving, at least, and getting better at it, if you learn behavioral aspects of the investing pretty early. It's tough to time the bottom. If you really think stock is attractive, buy it at the market, because if you're trying to time the market thinking that the stock, let it go down 50% or 40%, then I will make a buy, make an entry point. It is never going to happen, because when that happens, our mindset will not allow us to invest money when a stock is down 50-60%. That's the nature of it. You could try it, right? Unless otherwise you practice investing for a long time. With experience, you develop that mindset. Now the difference between making 40 times on investment and 60 times on investment is not really as important as missing the opportunity altogether. So for me, first I enter the stock, first buy, then analyze detailed, right? At least make an entry point so that it gets into your watch. If the stock quality is too good, make an entry point. And if you think after the entry point that it is worth more investments, do the investments, because if you wait for a few corrections, it'll get out of your mind, and then you end up never investing in that stock again. And it's better to have a 40 bagger or a 40 times on your returns rather than having a 60 times, right? So calculating that 10-20% gap is not worth waiting before investing. It's tough to time the bottom. Now, why people fail to make a fortune in the stock market? The point is that it is not necessary to buy little known stocks in the dark of the moon to get hold of a fortune maker. Most of us had owned one or more of them at some point of time in our lives. Now the funny thing is, our failure in investing has been to hold on. Most of the people would have invested in Amazon somewhere in 2005, 2010. Somebody would have invested in Apple, somebody would have invested in Nike. All of us would have invested in different companies in the world, right? Kind of Alibaba. But the problem is, it's not about investing in those ideas. It is about holding on. And that makes the difference, and that is my strategy. Now this is highly influenced by the book. Look, even I had my share of mistakes investing in many stocks and coming out quickly, selling out, not making the fullest of the returns. But mistakes do happen. That's why 100 to 1 in stock markets had a big influence in my life and in my investing life. And so holding on is the most important aspect. And the second aspect I'll get onto it is betting big on such ideas. Betting big on such ideas, investing in such ideas at a low price or a decent valuation, and holding on. That's it. This is all about investing, right? But it's easily said than done. Now the next is like the tortoise that won the race with the hare by keeping at it while the much faster hare explored the byways. The patient, stubborn and unflappable buyer of quality stocks compound and become millionaires even if they don't add another dollar. So an important lesson, right? Take the tortoise path, which when the tortoise won against the hare, which hare whereas tried different paths like trading in out, trying to get the fastest path, right? But if you just keep at it, holding quality companies for long periods of time, the job is done. So that's a path. It's a slow path, but it's a steady path, and it takes you to the winning line. Now in investing, pretty much like the race, right? If you just finish the game, you have won the game already over 20-30 year period. You don't have to finish the fastest. You don't have to get rich. You got to, as Warren Buffett says, you have to get rich only once. You don't have to worry about whether you get rich in 15 years or 20 years or 10 years, right? So it is important to finish the game. Now, how do I look at risk? Because investing is all about risk management, investing is all about valuation. So I was too much influenced by Howard Marks. I read his memo every month, and his books, the most important thing, and many other books that he has written. So a lot of interviews I've listened to, and I've learned a lot from Howard Marks. The way to look at he never calls, if you observe his interviews, never calls the top or bottom, but he says become more cautious at the top, and he will say become less cautious or become more aggressive in the bottom when the markets are in the bottom. So he is always a risk, his risk management framework is the best in the town, and I really follow his principles. So to make the most of the money in the shortest possible time, you should buy a good stock when nobody likes it. That's precisely, my friend, the strategy. We do get such opportunities. I would say, when I'm shooting this video 2 months back in 2022, a year where many stocks have been beaten down, there are classic compounders, the best of the companies that gets traded at single digit earnings. You wouldn't believe it. There are such companies. Maybe 5 years down the line, when we look back, we will feel, gosh, I missed that opportunity, right? So that always does come. Most people buy stocks with a goal of selling them at a higher price, thinking they are for trading and not for owning. This is Howard Marks in own words, right? This means they abandon the owner mentality and instead act like gamblers or speculators who bet on stock price moves. The results are often unpleasant. Don't just sit there, do something. But for investing, it is the other way, invert it. Howard Marks says, don't just do something, just sit there. That's what makes money. Develop the mindset that you don't make money on what you buy and sell, but you make money on what you hold. Think more, trade less. So the ownership when investing in companies, this is out of Buffett, Charlie Munger, Marx, Howard Marks, they all point to the same approach, right? Before you invest in companies, look at it as part ownership of businesses than looking at it as trading tickers, and don't buy a stock to sell it twice its price or thrice its price. Do not look at capital appreciation when you buy a company, but look at owning a great piece of business over long periods of time. That is the ownership mentality, and if you invest with that mentality, that's called entrepreneurship mindset, and that I've covered in my course, in the Game of Investing course, and that is one important lesson we all need to take away from. Now, I apply the concept of magic formulae to a great extent. Joel Greenblatt, it's a great screener. I would use it as a screener because getting quality stocks in that, Greenblatt's approach is very rare. It's like a needle in the haystack, and so rather I look at it as a screener. I get sometimes good ideas from that list of top 30, 50. You can just go to Google search Joel Greenblatt Magic Formula Investing. Go to that site, you search and filter, you get at least 30 stocks or 50 stocks. His concept is based on identifying companies which are trading at the best of the yields, and which means lowest of the multiples in terms of price, and which has a good return ratios in terms of ROIC, return on invested capital. So he has applied those two filters, and he gives a list. If you just search, you get the list. I've got many ideas, in fact, over the last few years. Great quality companies sometimes do come in that list. So I use that as one of the screener. Then other screeners I use as in terms of cloning mechanisms, which is propagated by Monish Pabrai, and there are some other methods I follow in terms of analyst reports, and keep a buy list, a watch list, which is something I derive from Charlie Munger. Have a watch list and a checklist. So watch list of stocks is helpful. Quality stocks are helpful when they come at bargain prices. You can jump on it, pounce on it, right? So having a watch list helps. Having a checklist helps in terms of your selection criteria. Now, valuation is an important factor. Valuation is if you read 100 to 1 books, or if you follow any of the greatest investors who have become billionaires from stocks or investing, is if you notice, they have bought those companies which has gone up 100,000 to 200 or 2,000 times in terms of price returns. Those stocks were bought at a very cheap price, right? And the price multiples do matter to a great extent. That is one of the easy filter, but then there are other filters which you can use, tag outweigh it against the growth, outweigh it against the return on invested capital, cash flows, and all of that. So price multiple is a very important factor, and valuation is important factor. It's not just multiple. Multiple only give you at a point in time, but if you really want to know the pathway, runway, where the multiple or where the company is trading in terms of its opportunity, you have to look at the ratio of total addressable market to the revenue or to the size of the company, right? So that is something which will help us evaluate the potential runway ahead. And if you get a long runway ahead from a quality business, with a quality business in hand run by great management, you've done it, right? So you need to figure out not just a point in time valuation, but look at valuations where the addressable market opportunity is very big, but not, and if it has run up already half the way, I wouldn't look at participating in that game, right? In that investing opportunity. So look at valuations where you get the advantage of PE re-rating, which is nothing but the multiple re-rating due to the change in fundamentals, due to the change in sentiments, due to the change in emotions, whatever, right? And that is a market related factor, and the earnings compounding is a given, right? So you need a combination of these two to make multi-bagger. And there are examples, right, where a stock would have just compounded 15%, which means it is a it's a 5 bagger over 10 years, right? But or 4 bagger over 10 years, but it is like it would have had a re-rating of 3 times, right? And that gives you a 15 bagger or 12 bagger, which is great returns over 10 years. So it need not be always earnings. It is earnings is a given. It's great to have earnings which can really multiply, compound the returns. But if you get a earnings compounder and a low price stock or medium price stock, you're sitting on a multi-bagger. So I would say that. Right now, how do I select addressable market? I look at there is a statement in 100 to 1 book, like every human problem is an investment opportunity if you can anticipate the solution, or if you can look at the solution and anticipate how it will address the market. If you can get this right, you are going to get great multi-baggers. Now, 100 to 1 in stock market had a big influence, as I said. One need not, this is from the book, you need 3 things: vision, patience, and courage, as the book says. Author says, to be successful in investing, to be finding multi-baggers. Now, one need not have millions in order to make millions. As a matter of fact, it is often easier to make a relatively small commitment of this sort than to invest $1 million. All it requires is vision to see the opportunity, courage and independence of mind to buy, when almost no one favored doing so, and most important of all, the patience to hold on through the bad business years of the late 30s, through world wars, through pandemics and all of that. And if you do these 3 things together, if you have these 3 things together, patience, courage and the vision, that's success, right? So he says patience is a virtue, have it if you can, seldom found in woman, never found in man. It is in the lines of what Blaise Pascal said, the man's inability, the greatest curse is a man's inability to sit in a room idle, right? So patience is something most important, which I'm still getting at. I'm still trying to practice. Getting there, it takes a long time to change your wiring, to improve patience, to inculcate patience rather. So we'll get there. To cultivate patience it's a tectonic shift in your mindset. Now, tenacity to hold, gritting the teeth. Excuse me. So the triumph of lethargy and absence of inertia. These are the 2 important concepts how to develop patience, right? The triumph of lethargy and the absence of inertia in investing, which means absence of inertia is frequent move out of the stocks, frequent trading of stocks, frequent buying and selling of stocks. These are all inertia. It causes inertia, and all these inertias are all these frictions causes tax that you have to pay extra, which otherwise you could have compounded the opportunity cost by selling it early. Many times we sell too early, after stock doubles, which goes on to become a 100-bagger. Then there is brokerages, many other commissions, many other things that you pay frequently, which are all friction cost. Avoid those friction costs. And the triumph of lethargy is inactivity, which creates money in the market. It's holding on, as Charlie Munger says. It's not buying or selling that creates wealth, it's holding, right? So tenacity to hold, gritting the teeth, no matter what the market conditions are, no matter what the business is going through, if the potential looks same, it's a good idea to hold on, right? So good growth companies with strong underlying fundamentals can decline 50 to 70% market value in bear markets, but only to turn around and make 100 out of $1 investments in the ensuing decade. So this is from the book. Ensuing decade, one can change into 100 times, even after stock corrects 50 to 70% during bear market. So if you are having the tenacity to hold, you could see a stock that goes 50% down 3-4 times during 20-25 years, but end of the day it creates 100 times returns, right? That's the nature of the market. Now, what makes a stock good? When asked that question, most people think of earnings. They are right to a point, but a stock can also be good because of assets, even though those assets are earning less at the current moment. Now, this is an important point. Markets are forward-looking, and investments should be forward-looking. We invest in a company, obviously studying based on its historical performance, many other things, but what really gives returns, what the market gives returns, is the future earning potential of the companies, the future cash flows, the future valuation re-ratings, multiple other things. It's all for the future that you're going to get your returns on. So you need to look at the assets, you need to look at the earnings power of the company for the future. The assets may be undervalued today, but it could be a lot more valuable in the future, or the products or services could be undervalued today, but it could change in the future. So look for companies that are innovating and companies that are undervaluing the assets currently. Now, good assets are potential earning. Since most people focus on earnings, you can acquire assets at bargain prices once in a while because the companies owning them are operating at a loss and there is no sign of a change for the better. This could happen to even countries as well. There are examples where countries are called uninvestable, and most of the times they turn around. And if the countries had shown growth path in the last 20 years in the past, like over the last 50-year period, the countries have been aggressive in growing, if the companies have been aggressive in growing, they might come back. We cannot write it off, right? So now, this is something which is very interesting for me. How much CAGR compounding is required to multiply a stock's value by 100 times? Now, we speak about 100 times. This is from the book, 100 to 1 again. So it takes, if you multiply a compound at the rate of 14%, it takes a stock 35 years to multiply it to 100 times. If you compound at 16%, it takes 30 years, and so on. So if you have to really achieve a 100 bagger in 15 years, which we all wish for, but that then you have to compound for 36%, which is close to impossible, very rarity, right? Now, if you're looking for stocks that might multiply in value by 100 times the next 15 to 40 years, we must estimate the chances that the earnings can continue to grow at a CAGR of 12 to 36%. So, and the CAGR of the earnings should compound at the same rate almost to get a 100 bagger, and aided by the tailwinds of a multiple re-rating. Now, the basic reason so few of us have ever made 100 to 1 investment is that we have never tried to do so. First of all, we should have a mindset when we invest that, look, I'm going to sell only after this goes up 50 times, 100 times, right? Only if we have that mindset before investing, we can see that 100 back. Only if you see it in our mind, we can achieve it. And unless otherwise we visualize that, we are not going to see 100 bagger, right? Most often we'll end up selling at 3 or 4 times after it has returned. Or if it goes down 50%, we might end up selling early at a loss. So in a sense, we have been brainwashed into looking for and acting on type of information that we have little or nothing to do with multiplying one's investment 100-fold. So we have been too much bogged down by the news, right? So news is the biggest distraction for 100 baggers. Much of the news is immaterial to the truly long-term investor. Some news has been the opposite of its seemingly obvious significance. Shrewd investors recognize bad news as a chance to acquire good stocks at bargain prices. This is why so often after a savage general market decline, we see the best stocks moving up first. Now, news often provides a reason or an excuse for switching from one stock to another, right? We are so much bogged down. The news keeps coming unabated, and there's a deluge of information every day these days in social media and news channels. We should cut this noise to achieve that 100 bag, otherwise it's extremely difficult. As individual investors, we need to focus on the futuristic earnings potential than the historical earnings itself. Historical earnings definitely gives us a guide path, and it helps us to analyze companies based on for valuations and many other factors, but it is an important thing to look at the future earnings potential. That's the most important thing, and future multiple re-ratings, right? So these are the two most important factors when it comes to investing for long term. Now finally, it's about the power of compounding. So putting all these frameworks in place, putting all my strategies in place, the idea I keep talking about patience and holding for long time, it's all to have the compounding engine going, and the power of compounding kicks in after a inflection point, and which we will not realize in the initial years, but it's a much back-ended process. So let the power of compounding work, and you tend to see this 50 times, 100 times, because the last 80% of return comes in the last 20% of the time that you hold a stock. So if you hold a stock for 20 years, the last 5 to 6 years would see the maximum compounding usually, especially it's applicable for your portfolio, not necessarily for all the stocks. There could be stocks where you could achieve first 100 times and then it could languish, but as a portfolio you would multiply, compound. If you hold a portfolio of say 10-15 stocks, if the compounding is right, then 80% of the return comes from the last 20% of time in that holding period. So holding for long is very important, and playing to the power of compounding is very important. That is a strategy, and be a tortoise to finish the race, and that's all it is all about, the game of investing. So I request everyone to join my Investors Academy if you find my approach right and easy to follow. And thanks for staying with me, and signing off, Sandeep, Anand.